We've seen credit card debt really spike in the US over the past few years. We recently passed $1.1 trillion in total credit card debt. And in recent quarters, we've started to see delinquency rates and credit charge offs on credit cards start to increase as well. Are we facing a credit card debt bomb that's going to blow up the US banking system? That might be a little bit of an exaggeration, but there's certainly some banks that are exposed to it. We're going to talk about that here. I'm Jason Hall. This is Investing Unscripted. We're also going to talk about some banks that you can invest in to reduce the risk of credit card debt defaults, upending your returns. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should check out our special link. It's right here on the screen. It's fool.com/unscripted. Again, that's fool.com/unscripted. Go to that link, and The Motley Fool is going to give you its 10 best stocks to buy right now. It's worth your time to check it out. Okay, let's take a closer look at US credit card debt over the past decade. So since early 2014, we've seen it rise from about 700 billion in debt to over 1.1 trillion dollars debt according to the most recent Federal Reserve data. We've also seen an increase in the delinquency rate on credit card loans over the past year. You stretch it out over the past 3 years and it's actually increased even more. So, on the surface, that's certainly a little bit concerning. We're starting to see interest between rising interest rates and higher inflation. We're starting to see consumers with a lot of credit card debt start to get squeezed. Delinquency rates aren't the only thing that's happening. We've seen some higher default rates. There are a few banks that are really, in particular, more exposed to this type of debt. A recent one we talked about here on Investing Unscripted was Capital One Financial, which is in the process of acquiring Discover Financial and is going to be just a behemoth in the credit card lending space. Let's take a look at a couple of things from its most recent financial results that might be a little bit of a yellow flag. So we highlighted this on the prior video, but I want to spend a little more time talking about it. Particularly, we're looking at its domestic card business right now, which is the vast majority of its credit card business. It does some international cards, but domestic card business is its largest. And we've seen interest income has increased as credit card interest rates have risen. But at the same time, we've seen its charge off rate increase. We've seen the delinquency rate increase as well. 30 plus day performing delinquency rate, 4.61% versus year over year, 3.43%. That's a pretty notable increase. Now, the net charge off rate, we've seen that rate also increase a pretty substantial amount, enough it's starting to impact the bottom line. Now, the good thing we highlighted on a prior video, the interest rates that it charges are more than enough to offset the charge-offs. But the point is that it's taking an increasingly large amount of charge-offs. It's a concern when we see that trend of higher charge-offs happening, because generally it's followed up with even higher charge-offs, particularly if we do see recession in the near term. That is a little bit of a yellow flag. I want to talk about another bank that has a tremendous amount of credit card debt, and that's Citi. I'm going to pull up some data from Citi as well here. So Citi is the second largest credit card issuer in the US behind JP Morgan Chase. Now, of course, JP Morgan Chase has over $3.5 trillion in assets. It has about $1.5 trillion in assets more than Citigroup. So even though it's the largest as a percentage of its total book, Citi has more exposure. Of course, Capital One has the most as a percentage of its total book than of all three of those. Now, NCLs, here is the number you want to look at for Citi. NCL stands for net credit losses. In the fourth quarter, just under $2 billion in net credit losses. That was a 22% increase from the third quarter and a 69% increase from the fourth quarter in 2022. We also got the full year results since it was the fourth quarter of 2023. $6.4 billion in net credit losses it reported in 2023, 70% increase from 2022. So we're also seeing it increase the credit loss build on its balance sheet, increased that 90% last year. So we're seeing it take larger losses, and we're seeing it continue to bolster its balance sheet for continued future losses. All right. So sounds kind of scary. Here's the thing. When it comes to numbers, it's all about the right perspective. I'm going to go back to the chart that we showed at the beginning. It looked kind of scary. We've got that big rise in credit card debt for US consumers, and that delinquency rate that has gone up. Now, let's stretch this out 10 years, put a little bit of context on it. Now, first of all, obviously, the amount of credit card debt has continued to march higher. There's more Americans, there's more people living in the United States. We're earning more money. Put those things together, and credit card debt as a percentage of people's income and wealth hasn't moved up as much as just the round number has. And also, that 3.2% delinquency rate, once we get through into the pre-pandemic period, it's not substantially higher than the 2.7 rate we saw at the end of 2019. And we stretch that out even further. I'm going to remove this part here. You see, we've really seen over the past decade kind of a historically low level of credit card delinquency rates. Part of that's because interest rates have been lower, been easier for consumers to pay down the debt. Also because the economy's been generally healthy, steady growth, haven't gone through major job losses, except for, of course, during the pandemic period. But then we had financial stimulus from the government that helped offset that. So I wanted to point that out, the long-term historical rate. Things maybe aren't as bad as they might have seemed. Now, I also want to talk about the impact broadly of credit card debt as total debt. And the bottom line is that this is all household debt. Credit card debt it's a measurable percentage, but it is not the end all be all in terms of the debt profile for US consumers. And then when you start looking, I'm going to pull these off, and then you start looking at some of these other delinquency rates for other types of debt. So again, we've got credit card losses here, right? Let's talk about other consumer loans, delinquency rates. Same trend. We've seen a little bit of a spike here at the end. Historically, still at very low levels. All loans, wow, that's starting to look better. 1.43%. Real estate loans, 1.78%. Again, we've got that huge spike here during the global financial crisis. But the point is, when you start to normalize these rates, look at them over longer periods of time. Yes, we're starting to see a little bit of an increase. Is that important? Yes. Is it concerning? Maybe not concerning yet, but it's something that's certainly worth following. That's absolutely the case. So again, let's circle back to the credit card debt and the banks that we've talked about so far. And should investors be avoiding those banks right now? So let me say this. We did the other video. We talked about Capital One Financial acquiring Discover Financial Services. And my conclusion for Capital One is that it is kind of a wait and see situation. The valuation of the bank is not cheap. It trades for about 12 times earnings. For a bank is certainly not super cheap for Capital One anyway, because again, the risk of its balance sheet. So you have to be just mindful of that risk. You look at Citi, and again, it's the second largest credit card issuer, but its credit card balances are a smaller percentage of its total book. They have other issues that they've been dealing with, trying to get their financial house in order. If I were an investor, I was looking to take advantage of banks right now, I would certainly be more willing to look away from those credit card exposed banks. Look at the ones that have more exposure to the debts that still are showing really good delinquency rates. Truist Financial is appealing right now. They have a lot of exposure to mortgages and other secured debt, trading for about 9 times earnings when a 5.5% dividend yield. You get some margin of safety built in, and I think that's a better way to go. I think Bank of America is also really attractive. They do have a large credit card book, but like a Truist Financial, they also have a really balanced book of lending, incredibly low cost deposits that gives them really appealing cost of capital. You get a really good dividend yield, stable business. Both of those are built a little bit better to get through the macro environment without the risk of credit card defaults upending their business.